Welcome, everybody. This is the HIG Podcast. I'm MattyP, here with the one and the only Bronson Kafusi. What's up, Bronson?
Yo, what's going on, everybody? Okay, should we keep it 15 minutes?
We can shoot for 15, but it'll be longer.
Okay, I will shoot for it.
MattyP's like, oh, I've done this way too long.
Well, you know what's funny? I was just sitting here thinking, just hanging out with you guys, listening to you talk. It's been a minute.
Yeah, it's been a long time.
Yeah, it's been 3 months.
I've really missed it. I really have. It's like, I don't know the last time I've sat here in my office and just like had this type of conversation, let alone podcast recording, but it's been a minute. We've been busy.
Oh, we've been busy.
There's a lot going on.
That's good though.
I mean, I say that there's a lot going on, and you know, things will calm down, but they don't ever seem to calm down, and we just get busier.
Yeah.
Which is why I think we are exceptionally lucky today that we have who we have today. We have Jason Harris.
Harris in the building.
Sit down with us here.
He's a Charity of Champions NFL charity flag football event owner, by the way.
Ooh,
he's here. He's
and future champion. My team looks ready to go. I'm excited.
Why don't you tell us a little bit about that before we roll into what we're talking about today? Charity of Champions.
Charity of Champions. It's my NFL charity flag football event. Harris Investment Group has a team. Jason's the owner. Jason gets to bring, 8 players, friends, kids. I know his son Jaden's going to play. Jason's going to play. Then we add 3 or 4 NFL guys to his team. And he's playing against other teams like Team Traeger, Jeremy Andrus, Team Minky Couture, Team Redmond Relight. And it's going to be intense. We'll have like 40 NFL guys there on these teams. Everyone's playing to win. The winners get some really cool stuff. And I can't tell you because it's a surprise. Maybe a Traeger maybe involved. Some really cool. You get a championship belt. You get assigned helmets. You get all this stuff. There's a lot on the line. So come check it out. June 27th at Corner Canyon, 10 a.m. Jason will be strapping it up.
I won't be throwing dimes, though. We've got a better quarterback now, so I'll be the backup. Hopefully the primary doesn't get hurt.
Okay, this is what we'll do. You guys will get up by a lot, and then you'll go in and just play the rest of the game. Let your quarterback rest.
Yeah.
There you go. Yeah. Well, this is, I know you did this last year, and it was a huge success. A lot of people had a lot of fun. It all turned out really well. And so I'm excited to see what this year will bring.
Yeah, it's going to be awesome. Yeah, check it out, charityofchampionsutah.com. That's where you can buy tickets to it, bring the kids. It's a good event. Just that many NFL guys in one place only happens once a year, and it's at this event. So come get those kids inspired by these NFL guys that are going to be there. So
unique opportunity, June 27th.
June 27th.
Corner Canyon.
In
Draper,
Utah.
Let's go. All right. Great. That was a very nice, unsolicited plug that we got there for you.
Yeah, thank you.
Yeah, that was really good.
Think about it.
I have a very unsolicited shout out to Mason Haycock. He has been anxiously awaiting for Jason to come back on the show. He listens to all your episodes. It's my stepson. He wants to model his career after what you've done, which I think is kind of cool.
Shout out to Mason. Great job. Yeah. That's awesome.
He got his mission call. I don't know if I told you guys, Guatemala.
That's awesome.
Quetzaltenango, or however you say it. Yeah.
We should talk. My brother-in-law's from there.
Oh, cool.
Or his mom's from there. But they go down. They run a really cool. They have a really cool foundation that goes down to Guatemala, and in the rougher parts they build houses and do all these things down there. They have a place down there too. Their company's based out of there. We should talk Guatemala.
Yeah. I'm sure he'd appreciate it.
Yeah.
And also, speaking of foundations, I feel like the foundation of what our investment play lately, it's evolved a little bit, but the last year and a half, maybe 2 years, has switched to gas stations and truck stops. We have a lot of people who ask us, what are you guys up to these days? Or what type of investments are you getting into? What's your prime investment? And luckily, we just recently closed one that we get to talk about today. And that's why we have Jason here. Jason knows all the details, can speak to it better than anybody else. And we also like to give kind of like a mid-year update on just what's going on. Because, I mean, honestly, it's been a minute. We've been busy, have a lot of logs in the fire, a lot of things that are happening. So, Jason, welcome to the show. It's a pleasure to have you here again. We're aiming for 15, right?
Thanks so much. Good to be back.
I think we have 7 minutes left.
Yeah,
So
that'd be great.
I better speak fast.
This is great. I'm excited. It's like Matty P was saying, there's a lot going on, and we just closed the deal, and I think it's amazing. I just want to touch on that deal. Just give us a little update, how that deal went about, what it was, just high level it for us, because it's a pretty cool deal.
It's our best operator that we work with. We have a ranking system and some different metrics that we look at, but we really love LV Petroleum and have been able to scale and grow with them as they've scaled, and have kind of analyzed what kind of growth we're willing to, continue to look at with them, but very pleased and happy with them. And yes, this was a deal that had some challenges with the loan, but we were able to find a great solution to get it closed. And I think we're really happy with where it came in at with the interest rate, the financing terms. And then LV still hasn't missed a single payment on any truck stop deal that we've done with them. I think we're at 8 or 9 now that we've closed, and another 4 in the pipeline.
Wow.
So that was just discussed. We have a site visit with them in Vegas here in a month or two, and regular dialogue, probably 2 or 3 times a week. We're actively talking with them, and Matt's built out something quite incredible that's monitoring each site as well as all sites across the country that are either Flying J, Pilot, Loves, or TA centers, for us to understand the profit margins being made on all diesel and gas sales, which just gives us a little strategic advantage to understand traffic volumes across the country. All that data is grabbed and pulled into AI, and we have some ways to analyze it further through Placer AI. So anyways, this truck stop site has a lot of volume. There's some renovations going into it that I think is going to drive some additional profits. And so, I invested in it. We had a family office that took the lion's share, and then an RIA group that came in for the third piece. And so really happy about that.
So this investment, just to give our listeners a little bit of info behind it, is it one truck stop? Is it a portfolio? Is it gas stations?
One TA center truck stop can go anywhere from 20 million to 50 million potentially. Just one.
Just one.
You wouldn't believe the type of volume that these truck stop sites can see.
Yeah.
We're talking about 10 to 30 acres that these truck stop sites can sit on.
And they need the space for the trucks.
Yeah, you've got
right?
plenty of amenities. We're talking about multiple restaurants, bay services to service the trucks when they're waiting. 100 plus parking stalls sometimes. I think this one was 80.
You said 80. This one was 80.
80. Yep. And then we've got diesel, areas for the truckers to fill up. You've got the restaurants inside, shower facilities, lounges for the truckers, convenience stores. So there's a lot of different profit margins. Charging stations on some. This new pilot deal that we're doing, it's got some charging stations at, and so something that we're considering for next year with our OZ fund. And so we're pretty excited about some things that we have in the pipeline.
Oh my gosh, this is so exciting. Okay, so I think many of us know I'm a numbers guy, just like Jason, Matty P. Graduate in statistics. So give us the stats on this deal. Like, how big was it? Why is it attractive for a family office to get involved in an RIA? Because there are certain metrics that you have to hit for these types of deals. And so, just go over the stats, the numbers. I don't know. I think it'd be interesting for everyone to know these numbers, because numbers don't lie.
Yeah, this particular deal was a $26.5 million purchase price, and most of them that we're pursuing are somewhere in the high teens to maybe mid 30s per site. Yeah, that type of range. We like that range. We're getting anything. We're seeing deals, transact on the market for 8 cap rate ranges with good operators or good brands, even sometimes in the mid 7s in today's market, depending on several factors. But we're looking normally in the 8.5 to low 9% cap rate if we're trying to work something out with our strategic operators that we're trying to grow with. And usually we bring some kind of value to it. A lot of operators are looking to scale their operation sides of the business, but don't own the real estate. And so Harris Investment Group can be a good fit. So typically we're expecting a higher cap rate or some additional value if we're going to bring in the capital for the deal.
Yeah.
But then you have others that do own the real estate as operators, but may not have the capital to pursue a strategic site where they may have an advantage of operating in that location. Maybe there's a jobber where they're able to source their oil, and so they can cut out the middleman, and that helps them hit a higher
oil
profit
deal
spread.
For them. Yeah, for the
at the diesel sales. And so we can be a strategic partner that buys the real estate, owns it for 3 to 5 years, and then they buy it back from us at a set price. So it's a contractual buyback. And so we have some deals like that. This was a standard market deal, the Montgomery, Alabama. We liked the truck volume there. We liked the EBITDA coverage. So we want to see at least a 2-to-1 ratio of EBITDA to the lease payment so that there's significant profitability for the operator. And then ability to scale. So we'll build in a 20-year lease contract with a 2.5% escalator. But usually out of the gate, we want a 6% cash-on-cash return for the investor or better.
Yeah, so it's coming through a triple net.
It's a triple net lease, so the operating costs are borne by the operator. Property taxes, insurance, it's all borne by the operator. And so we need to know they're profitable to address those costs.
Oh, that's a big deal. Yeah. You got to win on the buy.
As
you really
well
got
as
their operator,
as well as our lease payment, right? And so that's kind of where we have to dig into the details and analyze the strength of the operator and the site itself. What type of profit potential and what are concerns of that profit diminishing over time, and or what can we do to improve it so that it can increase, so that we can ensure timely payment of our lease payments each month. And so have loved this particular operator. That's where I got involved too. I don't think I had a lot of exposure within my own personal portfolio, which is why I wanted to go into this one along with the family office relationship and RIA. They liked it because the depreciation was really strong. So we're aiming for a 2-to-1 ratio. We overachieved, I think, that amount. We're usually somewhere at the 210% to even as high as 250%. Which means, Bronson, you invest $1 million, you'd get a $2.1 to $2.5 million depreciation loss. And so for family offices and, oftentimes some RIA clients, they've got a lot of passive income. And they'd love a depreciation loss that can offset the passive income and the tax liability. Truck stops uniquely, if 50% of the revenue or more comes from the pump, you can get all of the purchase price minus land depreciated in the first year. And so we're seeing 90 to 95% of the attributed value depreciable in the first year.
So put down 10.
Wow.
Put down 9 or 10 on this specific deal at 26.5. Take out the land at 10%, which is like 2.5. Now you're sitting at 24 million.
Let's call it 23, 24 million.
24 million.
Yeah.
And now that's what you're talking about is that's where that 2-to-1 ratio.
23 divided by 10, there's the 230%.
Yeah.
So
that's cool.
It's a fantastic
and cash flow.
Tax
that's what people
loss
don't realize.
benefit.
I think that's interesting too.
Before the economic benefit there, you get this massive tax deduction. And for those who have significant passive income, or for those who claim rep status, real estate professional, they can utilize the loss against other income sources, including ordinary income, capital gains, someone going through a liquidity event. That loss is very valuable to them because they can utilize it right away. And so that tax savings was very meaningful for the individuals who came in on this particular deal, as well as it is for me. We take rep status, of course. And so that's one. And then you've got your other 3 areas, cash flow, which is strategic. We want 6 to 7% out of the gate, with annual escalators built in to increase it over time.
Yeah, which is 75 bips or 50 bips? Or
50 bips, and it can be sometimes 75 depending on certain things. We want to keep a certain cash reserve in our operating accounts just to ensure.
So every year it goes up, just for those people that don't know what that means.
Yeah.
It's an annual escalator. Those bips go towards the cash to the triple net lease sale.
Distributable cash flow to the investor, paid out quarterly. Typically, sometimes we can customize that. But yeah, that's something that you'll see tangible. And then behind the scenes, you've got your principal reduction taking place as we're paying down the mortgage from those lease payments from the operator. And then obviously the appreciation's back weighted at the end when we sell. But we're typically hoping that we can sell to market a stabilized asset that has a proven track record. And again, I was telling you, 7.5% to 8% is what we're seeing right now for these types of deals.
That's great.
And so if we're picking these up in the high 8s, low 9s, and then able to retrade these in the 7.5 to 8 cap rate range, we'll overperform the guided expectation. We're not modeling that type of compression to achieve our IRR targets. So usually we're guiding to a 15 to 17% type IRR.
Okay.
And if that type of compression took place, we'll be above 20%.
Yeah, it's great.
So
it's a great deal.
Investors can be really happy. And then we'll always facilitate a 1031 exchange option on the back end, so we can continue to defer capital gains and any depreciation recapture that takes place on the sale. So that's what we look to do, is a 5-year target hold. If there's a reason why we have an investor come along in 2 or 3 years that's willing to give us 7.5% cap rate, which I do think is possible, we'll talk to investors and see if that's something that they'd entertain.
Yeah. Okay. So talk to me. That's amazing. So that deal closed just about a few weeks ago.
Last month.
That's amazing. And so now, talking about where we're headed here between now and the end of the year, beginning of next year. You mentioned the opportunity zones, how unique that is with the gas stations. Very, very intriguing. Very intriguing. So maybe could you high level that, talk about kind of what you're seeing between here and there, what we're going to do and between here and the end of the year, and then with opportunity zones.
So of course, it's been really interesting for me to look at the 5-year history of what we've done at Harris Investment Group. We're seeing more and more demand for truck stops. Triple net lease deals that have significant upfront tax benefits, and then that cash flow upfront day one right out of the gate. Compare that to our multifamily sector. We love the multifamily sector as well, but we haven't pulled the trigger in maybe 2 or 3 years at this point. We had one distressed asset that we did pull the trigger on, but it was a complete loss to the former sponsor group. We negotiated with the bank, and so that was really the only reason it happened. So if you look at it, Bronson, we've got a way to make a 15 to 20% IRR that we're pretty confident being able to hit. Most of it we get along the way because of the cash flow that we're hitting and the immediate tax benefit. Why would we look at a multifamily deal that is a similar return if that multifamily deal has a inferior tax loss benefit and the majority of the return is back weighted
and heavier lift?
And it's a much heavier lift, which is why there's no cash flow in the first couple of years typically. Until it's stable and you've renovated the units and you've hit your higher market rate rent targets. So look at the client experience. If you're an investor investing in multifamily, you've got to wait to see if the underlying asset and sponsor group are hitting their targets. So a lot of them are waiting to try to see, how are things performing and going, and it's not till the end that you're going to see really what that return looks like. Where on a truck stop deal, right away, if you're cash flowing and you get this big tax benefit that helps you on your tax return, immediately you're feeling good about how things are performing. And so it's really tough when you can have immediate return in a similar IRR in multifamily, which is why we're looking for a 20-25% plus IRR that we feel confident we can obtain on multifamily before we're going into that asset class. Whereas the truck stops, we're already hitting, the 17%, and we believe stronger that we'll be able to hit on these deals. And so that's why, truck stops right now we are really excited about. We're bullish on the truck stops. We've got some great operators that we've been in discussions with on how we can scale together. And so the back half of the year, we've got some some deals in the pipeline. We do have a Cubbies truck stop deal that we're closing on this month. That's fully subscribed.
Yeah.
And then a Pilot deal in Texas. Chuck just called me on. He's at the asset right now.
Oh, cool.
In Mercedes, Texas, just north of the border. So there's tons of truck volume that's happening, through that main interstate.
Yeah.
And so really love it. Pilot deals are very rare. It's typically a Berkshire Hathaway brand, and so they don't come on the market often. And so that one also, I think, is fully subscribed. And so looking out to what will be available on the back half of the year, which is really our busiest time, because a lot of our investor partners and
Q4, here we go.
many of them are looking to see what's my disposable income, what's my taxable income looking like, and how much would I need to allocate in order to generate enough tax loss benefits for 2026. And then, how much am I looking to invest for cash flow and what I can generate overall in return. And so we'll anticipate more and more demand coming as we head into quarter 3 and quarter 4. But right now we have 3 or 4 that we really like. We've got an amazing structure with these deals. I'm pretty excited to discuss it. And right now we're evaluating to offer a fund structure, if we're just going to have an SPV with multiple assets or single assets in them, along with individual ticks that we'll bring on. And those ticks can be cash. A lot of times we have 1031 exchange buyers also who are interested.
A lot of people need 1031 help.
Yeah.
We're a good person to call for that. So
typically the lender restricts how many we can have. We've seen 5 to 6 be kind of the cap. So normally we need to reserve $1 million or $2 million type spot for TIC investors, which is why then we'll have an SPV or fund take the remaining TIC spot so that we can fill it in with individual investors that may not be quite at the $1 million or $2 million size.
Yeah. Wow. This is exciting. I mean, I could ask you so many questions, and we will. We're going to be, we're going to be running a deep dive into the OZ side of things.
About to say, if you think that's exciting, Bronson, ask me about OZ. That's where things get real fun.
Yeah. Well, that's the thing. It's like the OZs are around the corner, and I know there's a lot of buzz around it over here at Harris Investment Group. And we're going to do a deep dive with Jason, our CIO, Matt Denning, and MattyP, myself. We're going to deep dive really deep into the OZ side, because there's a lot of movement there, and people need to know about it. It's something that everyone should be educated on, especially if you're a real estate investor, if you're having a liquidity event. So that's something I'm super excited to go really deep on that with you, because we all need to know it.
I think we should, Bronson. Just a high level type overview of it that makes it so great. And I just want to mention, we'll continue with our core strategy. OZs are only for capital gain investors and investments. And so our core strategy caters to any and all. And that's why we'll continue to have that be an offering. But we are really excited about OZ. I feel strongly that it's not going to be how much we can raise. That's not going to be the limit for us. It's going to be how many OZ eligible assets we can find that meet our criteria
that's the real
and the
challenge.
Criteria of OZ. And so
Find demand. Here we go.
We have a number of things that we're doing to try to find those opportunities that we like, that we'd want to pursue. But that's the biggest challenge. And right now, at the federal level, I think the tracts are going to be approved here soon, and then they'll be sent off to the states for the states and counties to then govern what is going to be approved in each state. And so we're really excited to see in October, November timeline what OZ areas on the map as part of OZ 2.0 that came out in the Big Beautiful Bill Act last year, what opportunities will be there. But the Big Beautiful Bill Act made it easier to go OZ, reducing how much additional capital has to be invested above basis on rural OZ, and then standard OZ as 100% above basis. And so we'll have 2 funds, most likely, that cater to standard and rural. Rural will probably fill up fastest just because it's easier, but there's going to be fewer opportunities there. And then the standard OZ, the only reason I say that is because you have to hit 100% plus of CapEx dollars that are put into the site, making it a little harder. But there's going to be more tracks that are available in the standard OZ. So really, really excited to start talking about it. We've got a few operators and and deals that we're considering and looking at.
Yeah.
And that'll be rolled out in Jan 1 of 2027. Technically, though, any capital gain event that happens after July 4th, back half of the year essentially, is eligible to invest in OZs starting Jan 1 of 2027. You have 180 days to place the capital gain. And so investors...
that sounds like it's a hot window. That's what, when I hear that, I think that's going to be a window where everyone's trying to fit in, and
we'll be trying to have everything ready to go long before the end of the year. So that there is those conversations that can be had with our tax professionals and RIA groups who, have kind of already expressed interest. So,
well, there's a little teaser for you. Like that's our next episode, right?
Yeah.
With Matt Denning and Jason.
Keep in mind, that's a capital gain event only, but anyone who would maybe has some significant appreciated stock, could be selling a practice or a company, that type of investor or group's going to have a lot of interest, I believe, in OZ. The tax benefits are so amazing, and we're taking our core strategy with truck stops and coupling it with OZ. That makes it even more attractive, where you can have this amazing tax-free growth on the underlying appreciation of the asset, deferral of the capital gain, and bonus depreciation loss benefits that can be generated year one. It's so good. It's so exciting. I'm analyzing my own portfolio right now of where I can take capital gains off the table in my own real estate portfolio, put them in OZ, and then defer the rest through 1031. It's not a either or. It can be a hybrid of both.
Yeah.
So we'll maybe do some kind of marketing material on that.
Oh, yeah. I think one thing that's exciting, if you're listening to this, if you're interested, so what Jason just talked about was he's going through his portfolio, and he's analyzing it with an OZ perspective for capital gains. So if you're interested in that, reach out to us. We can help you do that. And it's something that, I think a lot of people should be doing. And because there's a lot of upside there. And if you don't know where you're at, then how are you supposed to act? How are you supposed to make moves? And so let's find out where you're at. Let's uncover some different things for the opportunity zones. And that's just something that we'll do for free. So reach out for your family office, investor, reach out to us, and let's help figure that out for you.
Anyone who's heard me talk probably on stage or in podcast knows I love tax efficiency. So all things Roth IRA, Roth 401k, I am all about, because I love tax-free growth accounts. OZ is the closest thing that touches that for real estate and business. OZ is your mega real estate Roth. That's how I look at it, because it essentially allows you tax-free growth compounding for 30 years. Yes, there's this 10-year reset where all your basis goes up to whatever the value of the real estate's worth at the end of 10 years, but you don't have to take it out. You can continue compounding and growing it tax-free for a long period of time. And so just imagine a $10 million or just $1 million investment, whatever it may be, compounding for 30 years tax-free and getting depreciation loss benefits on it. I mean, it is really exciting.
I don't know how you beat that, honestly.
And imagine doing both, your tax-free Roth and your tax-free OZ. Yeah. It's just so amazing having multiple asset classes growing tax efficient like that. And so I'm really excited for us to roll that out.
Oh my God.
Sign me up.
Yeah. Reach out to us. Well, this has been great. This has been great. Thanks, Jason.
Yeah, thanks.
We love having you on.
Appreciate you having me.
People love asking you questions. People want to hear from you. It's been a while, and we're excited to really make this push here. We're going to do a lot of marketing. MattyP and I are going to be active. We're going to be interviewing a lot of people. We're going to be interviewing partners. We're going to be interviewing single-family office partners, CPAs. There's a whole plan here, and so we've been a little quiet, but we're about to turn it back on and hit the jet fuel here and get up there in outer space. So thanks for being on today.
Thanks,
if you have questions, reach out to us. Contact harrisinvestmentgroup.com.
Lots of fun things to come. Hope you find your dad. The HIG Podcast expresses the views of its participants and may not represent the views of Harris Investment Group. The views discussed are subject to change without notice. The HIG Podcast has no duty or obligation to update the information contained herein. It should not be assumed that past investment performance discussed is an indication of future results. Wherever there is the potential for profit, there is also the potential of loss. This is the very nature of investing. The HIG Podcast and its affiliates do not provide tax, legal, or accounting advice. The information shared on this podcast should not be construed as an offering, advisory service, or investment advice. Consult your own tax, legal, and accounting advisors before engaging in any transaction. This podcast, including the information contained herein, is the sole property of Harris Investment Group and may not be copied, reproduced, republished, or posted in whole or in part without the prior written consent of Harris Investment Group.